Hi, Jonathan Tacadena here from MPC Markets, and today I'm going to walk you through the modern wealth formula and the wealth consolidator. Here is our disclaimer. Now, the central question we want to answer today is, can you have income and beat the index at the same time? Traditionally, the answer has been no. If you want safety, you sacrifice performance. And if you want more growth, you give up income. There's always a trade-off. With the modern wealth formula, MPC Markets is saying you don't have to choose. You can have the best of both worlds. In this presentation, I'll walk you through the two core concepts that make the modern wealth formula work, and then break down exactly how the portfolio is structured. The first reason this approach works is that it's built on an equity index. Equity indexes are structurally designed to trend higher over time. Indexes are self-balancing. Underperforming companies get removed. The strongest companies always remain. Indexes have built-in diversification. A single index usually contains 100 to 500 companies. Indexes are low cost. Thanks to the invention of index ETFs, they have some of the lowest fees in the market, and it's hard to beat. Even professional fund managers consistently struggle to beat the index over a long run. The second reason the modern wealth formula works is leverage. Now, I know some people tense up when they hear the word leverage, but here's the thing. Almost every Australian investor is already completely comfortable using leverage. We just call it something else, a mortgage. Now, nearly all property investors are perfectly happy to borrow to buy an investment property. And unless you bought an apartment in Melbourne over the last decade, property has been very, very good to investors across Australia. But here's our key insight. Yes, property did build wealth, but it was the leverage that created the real wealth. The borrowed money amplified every gain. So leverage works. We simply want to apply it to an asset class, equities, that has historically delivered high returns than property. Also, we're using smart leverage. The leverage used has limited risk, so that we know from the start what is at risk. So the two principles at the heart of the modern wealth formula are the underlying instrument is an equity index, and we use smart leverage. Now let's get into the mechanics of how the modern wealth formula actually works. The traditional 60-40 portfolio was 60% equities and 40% bonds, or in plain terms, 60% growth and 40% income. With the modern wealth formula, we actually flip that ratio. We start with 60% income and 40% growth, but on its own, it's just a conservative defensive portfolio. The insight from MPC Markets was to ask, what if we use leverage to supercharge the growth portion, just like investors have always done in property? And that's where MPC Markets found the edge, which brings us to the modern wealth formula. It's 60% income and 40% smart leverage growth. And the result is more income and more growth simultaneously. Another feature of the modern wealth formula is that it is flexible. Today, I'm talking about a 60-40 ratio, but if you want more income or more growth, it's possible to change the ratios. So depending on where you are on your wealth journey, the modern wealth formula can adjust to achieve your goals. When we compare the modern wealth formula to a traditional portfolio, this chart shows the advantages clearly. If the market rallies, the modern wealth formula captures more of the upside. And if the market underperforms, the higher income component cushions the blow, meaning you still come out ahead. So yes, you really can have your cake and eat it too. You can have index and index beating growth in the same portfolio. Now, some people may ask, is a 4% outperformance per year really worth it? Well, that's where compounding comes in. If you have a consistent 4% edge compounded over 20 years, it doesn't just add a little, it transforms the end result dramatically. The difference becomes enormous. So let me leave you with this. The old 60-40 portfolio served investors well for decades, but the world has changed. Interest rates, bond yields, and market dynamics have shifted, and the traditional approach simply doesn't deliver what it once did. The modern wealth formula is MPC Markets' answer to that challenge. It's built on two time-tested ideas: the structural strength of equity indexes and the wealth-building power of smart leverage, combined in a way that gives you more income, more growth, and more resilience. Not more risk, not more complexity, more of both things investors actually want. If the modern wealth formula resonates with you, if you've been looking for a portfolio that works harder without you taking on unnecessary risk, then I'd love to have a conversation. Here are our contact details. Reach out to us. We'll send you a full modern wealth formula breakdown, no obligation, no jargon, just a clear picture of what this strategy could do for your portfolio. The best time to build a better portfolio was yesterday. The second best time is today. This presentation was meant to outline the core concepts behind the modern wealth formula. For those that want a more detailed explanation, we have a presentation from Kai Chen that will answer all of your questions. Thank you for tuning in today and hope you got some valuable insights from MPC Markets.